All right. Hello again, everyone. Krista Gardner introduced myself earlier this morning. So I'm going to go ahead and turn it over to Kristin, and she's going to get us started on digging in a little deeper on some areas of our financials that maybe are good areas for training or education and really understanding what they mean and how to use your financials for decision making.
Thanks, Krista. As Krista and Christina mentioned, my name is Kristin Delauter. I'm an audit manager in our Chambersburg office. I joined SEK in 2015, so I'm coming up on my 9-year anniversary this fall. I specialize mostly in auditing governmental entities, including municipalities, school districts, and other governmental entities, and do have some experience in financial institutions and non-for-profit organizations. So, Krista and I are going to go over 4 key areas today of your financials that are important for decision making, including the basis of accounting, whether you're using GAAP basis or another reporting framework, fund balance, what it is, and the 5 different classifications, interfund transactions, including due to and due from different funds, as well as transfers between your funds, and then analyzing your financials, how to use the information for a year-over-year analysis, as well as reviewing budget versus actual results. I'm going to start with the basis of accounting. There's 3 main bases of accounting. There's the accrual basis of accounting, which is also known as the GAAP basis. This is the generally accepted accounting principles, which is a set of accounting standards set by the Financial Accounting Standards Board, which outlines how to record and report financial information. So under this basis of accounting, revenues are being recorded and recognized when they're earned, and expenses are recorded and recognized when they're incurred. It's also known as a matching principle, where you are recording this regardless of when the actual cash flow occurs. Under the cash basis of accounting, the revenues are being recorded and recognized when the cash is actually received, and then the expenses are being recorded and recognized when paid. And then there's also the modified cash basis of accounting and also the modified accrual basis accounting, not featured on here, but I will go into some detail on that. These 2 bases of accounting do combine elements of both the cash and accrual basis of accounting. So the first basis here, the accrual basis of accounting, also the GAAP basis of accounting, is where you're recognizing the revenues when they're earned and expenses when the liability is actually incurred. So for the receivables that are being reported under the accrual basis of accounting, you're recognizing revenues, even though the cash has not been received yet. So this would include items such as tax receivables or intergovernmental receivables if you're receiving money from state or federal funds. It can also include grant receivables. For liabilities, you're recording expenses and recognizing expenses even though they have not been paid yet. So for liabilities, you would have items such as accounts payable, where you could have a project occurring during the fiscal year where services are rendered up through the end of the fiscal year. You're not paying that invoice until the end of the year. So that'll be included in accounts payable. Similarly, if you purchase equipment or supplies during the fiscal year and you're not billed until the end of the fiscal year and paying that bill until after the end of the year, you would record that as a payable. Also included in liabilities would be items such as accrued wages. So that accrued time for your employee's salary and benefits for any pay periods, either ending prior to the end of the fiscal year or extending between the current fiscal year and subsequent fiscal year. You would accrue that time and record it as a liability and an offsetting expense on your financial statements. The capital assets would include property and equipment that you are purchasing during the year that has a useful life of over 1 year. And it exceeds your entity's capitalization threshold. So similar, or the thresholds typically range between $1,000 and $7,500 for most of our governmental entities. And rather than expensing the purchase in the year that you make it, you would depreciate over the useful life. So this would include items such as building projects, large purchases of equipment or furniture. And then debt is also recognized on the accrual basis of accounting. So this would include notes and bonds payable, as well as any lease obligations that would qualify under GASB 87. The next basis of accounting is the modified accrual basis of accounting. So this is a current financial resources measurement focus where you are looking at when the revenues and expenditures relate to available funds. So for revenues, you're going to recognize them when they're available and measurable. This is typically following a 60-day rule for determining if the revenues are considered available. So for a lot of our school districts, when you assess taxes during the fiscal year, if you're not receiving those revenues until after the end of the fiscal year, you would look at those first two month payments after the end of the year to determine which amount of those taxes should be received or should be recorded as a receivable and the related revenue. Alternately, and some of our clients have grants that are reimbursement type grants where you're submitting expenses that were incurred during your fiscal year to be reimbursed. And those would be paid within 60 days. Sometimes it's 90 days, depending on the entity, and you would record those as a receivable and related revenue. For expenditures under this modified accrual basis of accounting, you would be recognizing them when the liability is liquidated with current resources. So under here, you would include the accounts payable that I described on the previous slide, but you would not be including items such as the debt payable or compensated absences for the accrued leave time for your employees, as those are typically only recorded when the payment is actually due. And then the last two, the cash basis of accounting is strictly based on when cash is received and paid. So you're focusing solely on your revenues and expenses here for your financial statements. So typically your balance sheet will only show your cash accounts and then your fund balance or net position. And then the income statement would have any revenues and expenses that were received or paid out during the year. So you would not be reporting any receivables, liabilities, capital assets, or debt. And then the modified cash basis of accounting, similar to the modified accrual basis accounting, does combine elements of accrual and cash basis of accounting. Typically, under this basis of accounting, you're just recognizing assets and liabilities when they result from cash transactions. So very rarely you would see any receivables or payables being recorded, but you would sometimes see capital assets that are going to then be depreciated over the useful life of the asset. And then the last slide I'm going to go over is our fund balance slide. So what is fund balance? It is the difference between your assets and your liabilities on your balance sheet. So it's the reserves that you have at the end of the year. As Kevin mentioned earlier today, there are 5 categories for fund balance. The first is the non-spendable. So those are items that cannot be spent because they're not in a spendable format. So items such as prepaid expenses or inventories, typically those match what's on your balance sheet, then to tie to that non-spendable fund balance line on the balance sheet. The restricted fund balance is an external restriction on your reserves. So these can be external from creditors if you have a debt covenant, or from grantors, or they can be imposed by a law or legislation. Some examples of this would include if you have advanced grant funds and your grantor is restricting the use of those funds, you would mark those advanced grant funds as a restricted fund balance. Or if you have a capital projects or capital reserve fund for your entity, those would be considered restricted fund balances. The committed fund balance are amounts that are being set aside for specific purposes, and they are imposed by a formal action, typically by your board or your supervisors. And then, as Kevin mentioned earlier, you can only decommit the funds through the same formal action that you use to commit the funds. So we do have a lot of clients that commit funds for future debt service or future retirement expenditures. The assigned fund balance are spendable amounts in other governmental funds that are not considered restricted or committed, or in the general fund, those would be intended for a specific purpose. So we primarily see these as the subsequent year budget deficit for a lot of our clients, where if you're budgeting a deficit of $500,000, you would be showing that as an assigned fund balance. And then the last category is the unassigned fund balance. So that's the spendable balance that has not been committed, restricted, or assigned. One thing to note for the unassigned fund balance is that you can have a negative unassigned fund balance on your balance sheet. due to restrictions or commitments overexpending what you have available in your reserves. However, if you have a negative unassigned fund balance, you do need to reduce your assigned fund balance to get the unassigned fund balance either to a positive amount or completely reduce the assigned fund balance until you get that to zero, and then the unassigned fund balance would be there, whether it's negative or not. So everything I have, and I will hand it over to Krista.
All right, so the next area that I'm going to jump in on is in regards to interfund transactions. So on the first two slides, we're going to talk about due to, due from transactions, and then on the following two, we'll talk about transfers between funds. This is an area where we often see a lot of confusion or get a lot of questions for help through the year and also during audit time. And then also even when we're talking about budgets and going through different training, this is an area that can be tripped up on. So in the first two slides here, when we're talking about due to, due from, these are transactions that we essentially are interfund loans. They will be paid back. So this is money that will be paid back, and the due to, due from accounts are used to accumulate those transactions until the actual cash is transferred. Once the cash is transferred and those interfund loans are essentially paid back, we then remove those due to, due froms. The one thing about due to, due from accounts is they should always balance across your funds. So your due tos in total should always match your due froms in total. So you want to make sure when there are transactions, like we're going to get to an example here, that you're always doing both sides of the transaction, hitting both funds, or it could be more than one, more than two funds that are involved. So in this example, the general fund pays an electric bill of $100 on March 1st. The sewer fund has a $25 portion of that bill. So they are able, this entity tracks their expenses in a certain way that they know it's either a certain percentage, or maybe there's a separate meter at a sewer facility where $25 of that $100 bill is the sewer fund's portion. So the general fund pays the entire $100 and the sewer fund owes the general fund $25. The sewer fund then reimburses the general fund 2 weeks later. So Christina, if you can go to the next slide, we're actually going to look at these transactions. So in the top half on March 1st, we're going to record the bill being paid. So you can see on the general fund checking account, we are going to credit $100. The bill is being paid in this scenario here. And then on the left-hand side are the debits. We're going to record an expense on the general fund of $75 because only $75 is the general fund's expense. The other $25 goes in our due from sewer fund account. It is an asset to due from, so therefore it is a debit balance. So you can see here on the general fund, our debits and credits balance $100 on each side. On the sewer fund, at the same time, we want to also record the sewer fund's portion of the transaction. So we debit the expense account for the sewer fund, recording that fund's expense of $25, and then we credit due to general fund, or the liability, for $25. If we only did the general fund portion, now our due to, due froms across the organization would not balance. When we do both sides of it, due to and due froms balance. We have due from of $25, due to of $25 across the funds. So this is the entry that records the expense and then records the fact that money is owed between two funds on March 1st. Now, in this example, we go 2 weeks later to March 15th and they transfer the funds. This can be different for every organization. Maybe you are transferring the money the time it's happening, or maybe it's every month, every 2 weeks. Sometimes it goes a little farther than every month. It just kind of depends on your entity and how often these transactions are occurring. But in this scenario, 2 weeks later on March 15th, they actually transfer the funds and pay it back. So what happens here is on the general fund, you can see $25 coming into the checking account, so a debit, and then we reduce the due from sewer fund account of $25. So we're removing that due from, and we now have the cash in the general fund's checking account. The opposite then happens on the sewer fund. So you can see $25 coming out of the checking account via that credit, and then we are removing the due to general fund $25 balance, or decreasing it, obviously, if there were other things in here. But you can see again on both March 1st and March 15th, the due to and due from accounts are being hit. So they're staying in balance. And then essentially we're making sure that the expenses are on the proper account. That's a lot of times what the confusion is how does the expense get on the sewer fund and only the general fund portion gets on the general fund. So you can see here how that should be handled. And again, always making sure that those due to, due from's balanced. So on the flip side of things, then we have interfund transfers. So a transfer is not a loan. Essentially, it will not be paid back, or that's the theory of it will not be paid back. It's one fund giving money to another fund. Now, little asterisks here that I don't have on the side. There are restrictions between your different types of funds and what money can be transferred out of those funds. You often can't have the sewer fund transferring money to a liquid fuels fund or other types of scenarios where there is a restriction based on where those funds can go. But in this example, which is very common, the general fund is budgeted to transfer $500,000 to the capital projects fund towards a new building project. So maybe in this scenario, the building project's happening that year, or they are setting money aside each year towards a new building project that could happen in 5 years. So it's included in the budget that $500,000 will be transferred from the general fund to the capital projects fund. The money was transferred on April 15th. So we're going to go to the next slide. And essentially nothing happens in this scenario until the transfer happens. So on the top, on the general fund, you can see $500,000 on the credit side coming out of the checking account. And then we record a debit of transfer to capital projects fund. So that is an expense type account. It's a transfer out of the general fund. So our general fund transaction is balanced, $500,000 coming out of the checking account, and we show it as a transfer of $500,000 to the capital projects fund. On the capital projects fund, we show the money coming into that account, so a $500,000 debit, and then we show a transfer from general fund or a revenue account, a transfer in of $500,000. So here's where the money is actually being moved at that time, and then we're recording those transfers. The transfers need to balance, and then each fund needs to balance. The only thing I'll point out here is sometimes we do run into, say there was a budgeted transfer, but the cash did not happen before year end. That's now where you could have a transfer and a due to, due from because the actual cash did not get transferred. Try to eliminate those scenarios as much as possible so you don't have balances rolling from year to year and clean up things at year end. But that can happen where essentially you would have a transfer of funds, but the actual cash didn't get transferred. So it also shows as a due to, due from. But the important thing here is really understanding that a due to, due from is an interfund loan. Essentially, the money will be paid back. A transfer is we are moving cash from one fund to the other. There is not an expectation that it would be paid back. Moving forward from interfund transactions is kind of the areas to think about as far as utilizing your financials. And I touched on this a little bit in our first session this morning, but where to start on what our financials mean and what are the conversations that should be had with the key players of your entity. And those are the people who are going to be putting together your budgets, going through any major project discussions, making those decisions, making sure that everyone that is in those positions has a true understanding of what these financials mean. The three items that we just talked about as far as basis of accounting, fund balance, and then the interfund transactions really go into play in understanding what funds you have, how the money is going back and forth, where it's coming in, where it's going out, and how it all relates to itself. So then the next kind of step is identifying, how do we use this information to make decisions? So year-over-year trend analysis are often good for understanding the past and then creating an expectation for the future. We always like to see at least 3 to 5 years when you're looking at any kind of trend analysis. And you really need to be mindful of what occurred in those 3 to 5 years. So if you're in 2022 and you only pick 3 years back to look, you're now looking at 2019, 2020, and 21, which was a lot of COVID that happened in there. So that's where sometimes you need to be mindful of what was going on during the time frame you're looking at and potentially expand it further, even to 5 years or more, depending on what you're looking at. Having expectations of your entity's history and then what it means going forward, you really need to know what was going on and what you expect to happen going forward. So making sure that you're identifying any grants and funding sources that can change. We have a lot of funds, funding sources or revenues that are consistent year over year, but then we also in the government world have a lot of grants or funding that is one time. So making sure that in all of the reporting or analysis that you're doing, you're pulling those types of items out to truly understand what the expectation should be. If it's a one-time grant, we shouldn't be expecting that as part of our revenue sources for funding projects, salary increases, et cetera, going forward. Tax rate increases. This is another area where it's important to understand what increases your organization has done over the past and what increases you have expectations for going forward. And how does this relate to any capital projects that might be happening, whether it's new vehicles or new buildings, any debt scenarios where you might be trying to pay down debt? How does that tax rate go into not only the operations of your governmental entity, but then those things that are above and beyond the day-to-day operations? Same thing with that is if it's applicable and you've got water and sewer funds, if what rate increases there's been for those in the past, what needs there's going to be when you're talking water and sewer or other utilities. There's a lot of capital expenditures that are happening, a lot of repairs that happen. And so really having an understanding for what the needs are going to be and trying to plan out those increases. That's the key. Also is really trying to understand where you need to get to in the future to plan ahead so you're not waiting until the last minute to do any kind of large increase all at once. Salary and benefit trends. Oh, there is another pop-up. You want to make sure you answer that question. Salary and benefit trends. Are you doing salary studies for your governmental entity? Do you have bargaining or union agreements where you already know what your salary changes are going to be? Benefits, obviously, are, what are the trends with whatever healthcare benefits or other medical coverages that you provide to your employees, and also any retirees where you need to be taking that into consideration as far as what those trends have been and what the expectations are when budgeting for the future. And then positions. Are you a growing entity where you're adding new positions? Are you, trying to maybe change some positions around or readjust your organizational structure based on maybe people leaving or retirements, or trying to cut on budget? Or maybe there's new programs that are coming in where you're trying to adjust people, or new initiatives as far as if you're a local municipality and you don't have a recreation program and you're trying to pull that in, are you maybe utilizing some other positions? So making sure that you've got an understanding of any changes that have occurred or will occur when you're identifying any of those financial trends that you'd be using to make decisions. Your budget, obviously a budget is not perfect, but understanding your budget process is the key here. So making sure that the right people are involved in the budget process, making sure that there's discussions as far as how the budget process should be handled, what the expectations are, and then essentially the assumptions. So a lot of times in budgeting, there are assumptions that are being made. A lot of them are the things up above. What increases are we potentially going to include? What salary adjustments, COLA adjustments, what benefit changes? What are those assumptions or methodologies that are being used when putting your budget together? That should really be in all of your meetings or discussions regarding budgets. That should be forefront in the discussion, because that's almost more important than looking at the individual numbers. It's understanding, okay, our bottom line as presented right now in our budget is based on these assumptions or these decisions that we have made in putting together the numbers. That's then where the conversations can go with, okay, if we want to add this in or subtract that in, how does that affect the financial position we're looking at? Unexpected items, we talked about some one-time items, but keeping notes and all of the budgeting documents as far as where the information came from, what it means, why it's a one-time item, is it unexpected, were there any miscalculations, or was there anything that we learned from the last budget process? Because a budget is not perfect, it's our best estimate. We learn something new every day when it comes to our financial transactions. So what items have we learned that we can keep track of and that are helpful in creating the next budget in the following years? On the next slide then, just be aware, we talked about basis of accounting, and this is one of the things that I think catches people up when looking at their budget or even putting together the budget, is what your basis of accounting is. This has a large impact on how to interpret any changes year over year. If you're accrual basis, we called it the matching principle, as Kristin spoke to. That is more where anything that's related to the year, revenues are earned, expenses, the liability has occurred, you're accruing for that all within a year. So that's more of an apples to apples comparison year over year. But when you get into being a cash or modified cash basis entity, you're now not recognizing revenue until it's received, or even recognizing the expenses until they're paid. That can create some inconsistency in timing year over year. Taxes are an example of that. Even health insurance bills can be an example of that. If you pay 13 health insurance bills in one year and 11 in the next, just based on when you cut the check, that's going to have a big impact on what those budget numbers look like year over year. So you want to make sure that you have an understanding of, okay, we're modified cash basis. This is cash in, cash out. Oh, I see this line item, say it's health insurance. There's a significant change from one year to the next. Let's look at why. Okay, there was 13 payments in one year, 11 payments in the next, just based on when the checks were cut. Noting that, documenting that, so you don't catch yourself saying, oh, we had a decrease in our health insurance. We can budget at that 11-month payment. Well, then obviously you're going to have an issue going forward. And that's just one example. This can really be across the board when it comes to cash basis, because you could get billed for something late. It could just be the timing of things. You've got revenues that are coming in. Maybe you've got certain things that are quarterly, certain things that are not consistent. Your tax revenues at the beginning and the end of the year can be based on another year. So that true understanding is really important for people to understand when they're putting together your budget, understanding the budget, and then using that budget as far as a analysis as far as budget versus actual, because there can always be some issues related to that. And that's where those notes should be happening. And essentially, even in a meeting, calling out, hey, we're over budget, but it's because of a timing issue. One-time items that are key to understanding your true trends, as we talked about, we had a lot here with COVID-19 these past couple of years. I think most of us are on the outside of that, where most of that has dwindled away, but there is still some ARPA funds out there. So being mindful of that, but also other one-time grants or funding opportunities that we spoke about, and then capital projects. So this is something, even if it's just your annual road work, that changes year over year. Sometimes you're using liquid fuels money for your road work. Sometimes you're using general fund money for your road work. If you're a school district, there's different grant opportunities that are coming in that you can use towards salaries. So really having an understanding of if there's a change year over year and where the funds are coming in, what the funds are, and then how those funds are being used, or in the capital project sense, if we are preparing for the future. So say we've got a project we know that's going to happen in 5 years, and we're able to put money aside each year, we obviously want to be calling that out as kind of although it might be, a same amount over 3 or 5 years that we're putting aside, it truly is a one-time item where we're preparing for. So making sure that those types of items are identified and everyone is understanding of those. On the next slide then, what we do with the information. So this is the last slide we have here. And this is, again, just understanding the revenue streams, really having a true picture of what the organization is doing day in and day out. What does it take to keep the doors open and provide the services that you're providing? And then also understanding those one-time capital expenditure, those extra items, or even the goals. So is there a new service or program or department that you're trying to ramp up, add in, prepare for? That's really going to help you understand, okay, from, as of today, here's where we're at operating wise. Do we have the fund balance to invest in something new? Do we have the fund balance to meet, if you've got a certain fund balance policy, to have 3 to 6 months of operational expenses on hand? That's where you get into trying to determine, okay, are we set up for success? What is it that we can do differently? Very important when we're going into bargaining discussions, whether it's with a police or a non-uniform union. Important when we're considering any potential capital projects, and also understanding, what is the fund balance picture that we truly have, that we can fund these things in addition to potentially having to take out debt or get in, go after grants, which is obviously helpful when we can bring in grants for any kind of one-time investments or items. But also understanding that there might be one-time cash influxes to help with new initiatives, but then making sure that you can year over year continue to fund those items if it's only a one-time influx of cash to get something going. So understanding that from that budgeting standpoint, and then also the cash flow. So, are you an entity that's got a significant cash balance and you're in good shape? You've got reserves, maybe you have a reserve policy or you don't have a reserve policy, but you've got a good amount of reserves on hand in order to, help if, another pandemic happens and, tax revenues, you've got issues with cash flow coming in, really understanding what your cash flow needs are. There are some governmental entities out there that have to take tax anticipation notes because they don't have the cash until those tax revenues start to come in the door. And so understanding who you are as an entity and where it is you have needs as far as cash flow or what you can sustain going forward. And that helps you plan for the future. So we talked about if there's new initiatives, if there's capital items, understanding what the needs are, especially if you are an entity that has old buildings, you're going to have a lot of deferred maintenance that's going to be coming up, capital items. If you've got utilities, there's often a lot of repairs that go with that. And then just the cost of doing business. As we've seen with inflation, there's been significant changes over the past couple of years. Our governmental entities are providing a lot of services to the public. There's a lot of cash that comes along with that. And so essentially being able to plan for the future and understanding where are we at? What is our health? Essentially, what's our wellness as a financial picture? And then being able to use that information going forward to plan ahead. So I think that's all that Kristen and I have on this today. If there are any questions, we're glad to try to answer those.